Good day, everyone. It's nice to be here once again. Thank you for joining the accounting class, the financial accounting class. And today we'll be looking at IAS 8. And if possibly, if time gives us, we have enough time, we'll also be looking at IAS 7. We'll be starting with IAS 8. And if we can complete it, complete the two standards, then we'll continue during our next class. But the first time we'll be looking at IAS 8, which is the accounting, one of the accounting standard covered under the PPFA, under the financial accounting class for ATS 2. I'm sure you are aware about, you have to go through about 5 accounting standards for this course. The primary ones are IAS 1, preparation of financial statement, IAS 2, cash flow. You have IAS 2 inventory rather, IAS 7 statement of cash flow, IAS 8 accounting policies, changes in accounting estimates and errors, and you have IAS 16 property, plant and equipment. You have looked at IAS 1 and IAS 2 already, that was taken by my co-tutor. And now we're looking at IAS 7 and IAS 8, and we'll be left with IAS 16 to look at subsequently. So IAS 8 covers accounting policies, changes in accounting estimates, and error. That is the aim of the standard. And the aim of IAS 8, accounting policies and changes in accounting estimates and errors, is to enhance financial statement to previous period and to this. Okay, so as we said, IAS 8 focuses on accounting policies, changing in accounting estimates, and errors that are made in the financial statement. This is one of the standards that we are looking at in our curriculum under ATS 2 financial accounting. And I also said that there are other standards that we have to look at, IAS 1, IAS 2. We are looking at IAS 8 now. We're going to look at IAS 7 later on and IAS 16. We've gone through IAS 1 and 2 previously with my co-tutor. I'm going to take IAS 7 and IAS 8, and possibly if we can't finish it today, we'll continue next week. Then subsequently, we'll be looking at IAS 16, which is property, plant and equipment. But for IAS 8 focuses on accounting policy, one side, changes in accounting estimate, the second side, and errors made in financial statements after they have been published. Those are the 3 areas that it focuses on. And I was saying that it looks like a 3-edged sword, not 2-edged sword this time, because it focuses on 3 areas, not like any other standard that most of the time focuses on one direction or one area. This focuses on 3 areas. Policies, accounting policies, how to select policies, when you change policies, what are the disclosure agreements, what are the accounting treatments for the different when you change policies, what are the criteria for selecting accounting policies, and when you change them, how do you treat them, how do you disclose them? The same thing with when you're changing accounting estimates, or when you have you made an error in the previous financial statement. What are you doing about it? This IAS 8 is what focuses on it and how they should be treated. So join me as we go on this journey. And I also said that the much of IAS 8 is really concerned with how changes or corrections should be reported in the financial statement. Most of the questions you will see is how does it affect? How will you treat this? Do you understand? It's more about the treatment and the disclosure requirements. It's really, really more about the treatment. So let's just move ahead. And we'll be starting with the first one, accounting policies. What are accounting policies? Accounting policies are the specific principles, bases, conventions, rules, and practices applied by an entity in preparing financial statements. That is as defined by the standard IAS 8. So accounting policies are those specific rules that has been set. For example, you must depreciate your assets over a useful life. That's your non-current asset over a useful life. It's an accounting policy. That's an accounting policy. And you have such accounting policies like that. And under IFRS, there are alternative treatments are possible in making it more important for an entity to state clearly which accounting policy it has used for the preparation of its financial statements. However, IFRS allows you to say this is the policy you want to use. This is the policy you are going with. However, you must apply that policy consistently so that, and why will you say you should apply it consistently? This year, you don't want to say your policy for depreciating asset is straight line. Next year, you now say it's reducing balance. The following year, you now say, so you won't be able to compare it. Do you understand? You won't be able to compare it. So we're saying that you must apply accounting policies in a period with similar transactions and other events in a similar circumstance. And the only reason where you may not be able to apply for similar transactions is only where IFRS has specifically requires or permits categorization of such items. So how do you select accounting policies? From the in Nigeria, we're using the International Financial Reporting Standard. Any area that is covered by the IFRS, any area that is covered by the IFRS, you must follow the IFRS standard. You must follow the IFRS standard and you must apply the principles set by the different IFRS standards, the different IASs, the different IFRS standards. You must apply it to deal with that particular item of the financial statement. And for areas that are not covered by IFRS, the management of the company. When we use management, it means the management of the company, the owners of the company, the people that are managing the day-to-day affairs of the company. They shall develop a policy that is reliable and relevant to the decision-making needs of the user. So it's these two areas that you have. Where there is the particular section or the business is not covered by an IFRS, then you can use any policy that the management of that company have developed. Do you understand? They can use any policy that they have developed, or they can use a policy of another financial reporting standard that has been developed. But in a situation where there's an IFRS standard covering that area, you cannot pick another accounting policy. So what if there are now changes in an accounting policy? Oh, the policy says that I must apply my policy in a consistent manner, right? But what if there is need for change? Now, an entity can change its accounting policy only if it is required by a standard. And in what situation will a standard require that you change your policy? Their standards are sometimes repealed and an updated one issued. So when an updated standard has been issued, a firm is expected to change its accounting policy. Let's just say, which example can I give right now? For example, for PPE, you can recognize at cost, right? Historical cost, or you can recognize at revalued cost after you have revalued the assets. Let's say in 2 years' time, the International Financial Reporting Standard now repealed current IAS 16 and replaced it with maybe IFRS 20 something and added another clause to it, or removed that you should stop valuing assets at revaluation again. I'm not saying this will happen. I'm just using this as a silly example. Then it is required that you would change your policy if you have been recognizing your asset by revalued cost. Do you understand? Then number 2 is that if the change will result in the financial statements providing reliable and more relevant information, if the change would result in providing reliable and more relevant information. So the first part is an involuntary change, meaning that you don't want to change your policy. You were forced to change your policy by a standard. Like when Nigeria changed from, all the company in Nigeria changed from doing Nigerian accounting standard to IFRS. It's a change. Everybody has to change. The CBN gave banks then about 2 years or 3 years to implement gradual change from the previous standard that we're using to IFRS. But let's even now say IFRS repealed the standard. That's involuntary change. You don't want to change. Involuntary change as required by a standard. Voluntary change is that you know that this current standard that you are using is not allowing you to really give the users of the financial statement a fair information or reliable information, or the information you are providing does not really represent the true and fair position of the organization, then you are allowed to change your accounting policies. And this one is what we call a voluntary change. Then the next one in the first part of the standard is, how do you now determine when there's a change in an accounting policy? Number 1, you can determine it either through recognition. You were capitalizing your assets, capital expenditure before. Now you are writing it off. Like once you buy the asset, you just throw it into expenses. You have changed. That's a change in accounting policy. Number 2, in measurement. Are you measuring your non-current asset at cost, or you are measuring it at valuation cost, at revalued cost? Number 3, how it is presented, presentation. Is your cost classified as cost of sales or administrative expenses? For example, some people, they put some of their cost and add it to the cost of sales, so that by the time they are getting their gross profit, almost all their costs have been embedded into their cost of sales. While some people will only just put direct cost, or they will just put material cost in their cost of sales, and every other expenses like personnel cost, even if you like, be the direct personnel cost, they don't care. Administrative staff salaries and wages, they put them under operating expenses. Do you understand? So if you were presenting it this way before and you change it the next year, let's say for example, I made 1 million last year in sales. When I got to my cost of sales, cost of materials only, is 500,000. My gross profit will be what? 500,000. The following year or the previous year, what I recognized, I still made the same 1 million naira in sales. But just to show that I've been efficient in doing production, I now decided to remove all my direct expenses, like staff salary, direct staff expenses that were directed to the cost that I included in my cost of sales in the previous year to make it, let's say 700. I removed it. Now it's 500. My cost of sales, my gross profit in 1 year will be 300. My gross profit in another year will be 500. So it does not aid comparability. So in presentation, you could also notice if there's a change, if there has been a change in accounting policy or not. So the 3 ways to notice whether there's a change, to determine whether there's change in accounting policy, is recognition, in how it was recognized. Number 2, in how it was measured. And number 3, how it was presented. Now let's look at how do we treat the changes in accounting policy. Application of change in accounting policy. How do we treat it? If it is, when I said it then that if it is involuntary and when it is voluntary. If it is involuntary, that's when it's required by a standard. When it is required by a standard, that particular standard may say it should be, the application should be retrospective or it should be prospective. If it is retrospective, it means that we should go back and correct those things and apply that particular standard that we want to use now and apply it to the previous financial statement. However, it might also state that it should be retrospective. In any case, if it is not a change that is required by a standard and it is a voluntary change, me as an organization, it's me that said I want to change my accounting policy, then the application of the standard should be retrospective. Retrospective is, again, I'm explaining retrospective again, is that you apply it to the prior years. You apply it to the previous years, the previous accounting years, so that the effect, it will now look as if you've been using the policy from a long time ago. Where a change in accounting policy is applied retrospectively, an entity should adjust the opening balance of each affected component of equity for the earliest prior year and the other comparative amounts for each prior period, presented as if the accounting policy had always been applied. That was what I just said now. And it is only when it is impracticable to determine the effects of the change that the entity shall apply the change prospectively. For accounting policy, the normal way is that it will be applied retrospectively. Retrospectively is we'll check backwards. However, there is a condition that if it is not possible to apply this thing backward, if it is not possible to apply it backward, then we will look forward. We will leave going backward, then we will move forward. I've spoken on determining whether there's a change in accounting policy earlier. So we'll continue to the disclosure of accounting policy. Disclosure. How do we disclose accounting policies? In the note of the financial statement, we'll disclose it there. And if the change in accounting policy is due to application of standard, the entity must disclose the change when it has an effect on current and prior periods, or it will have an effect in the future periods. If it is impracticable to determine the impact, the entity must disclose the title of the standard and the nature of the change. If A standard is what asked you. If you look at this accounting policy, before we go to you, if you look at it, everything has to do with how did it come by. Look at it from here. Is it covered by IFRS, not covered by IFRS? That's how you select. It's covered by IFRS, you stick with IFRS. Look at the second one. How do you know changes in accounting? How do you changes in accounting policy? You only change on two conditions. One, by standard. Number two, voluntary change. If you are, how do you treat it? If it is required by standard, the standard will state how to treat it. Should you go forward or should you look backward? If it was you only have only one option, to go forward. How do you treat it? How do you disclose accounting policies? If it was required by a standard and it has a change, then you disclose on your financial statement like that. But if it does not have a change on your current financial year or the previous financial year, and it will affect your future financial year, you still have to state it. And if it is impracticable to determine it, you disclose the standard, the name of the standard, and the nature of the change. Then when it is a voluntary change and the entity is unable to determine the future or past impact, the entity shall also disclose the nature of the change and the reason for the new policy, providing reliable and more relevant information. If you look at the disclosure, it's just one thing is clear from both sides. You must disclose what happened. We are changing our policy to this, from this policy to this policy. Then you state the reason for the change. Oh, the change is necessitated by a change in accounting standard. No, it's necessitated because the old policy does not allow us to fully declare. Then you state it. That's just the impact. Now let's look at this illustration to be able to explain that retrospective application that we were talking about. See, a company presents comparatives for the previous year only. So if you look at financial statements, which I told you guys to download several times now, financial statements, you would usually see current year and prior year, and the last year, current year and the previous year. So you see this information for this current year and you see the information for last year or the prior year. That is comparative periods. Now let's look at this. During the year ended 31st December 20X9, the company changes its accounting policy, and this change must be applied retrospectively. If there were no change in accounting policy, the company would present statement of financial position as at December 20X9 and December 20X8 only. However, because there is a change in policy, the company must also present a statement of financial position as at January 1, 20X8, which is what? The beginning of the earliest comparative period. The change in accounting policy is applied retrospectively. This means that the change should be applied to the balances as at January 1, 20X8, as if the new policy had always been applied. Similarly, any other comparative amounts in previous periods will be adjusted as if the new policy had always been applied. This for accounting policy. Just know that number one is that it should be applied what? Retrospectively. And what do we mean by retrospectively? Please, can somebody help me out? When we say apply it retrospectively, what does it mean?
That is, it should be applied to the previous years.
Yes, previous years balances. And you make sure that you apply it up to the beginning of the earliest comparative period. So if you are in 2019, normally you just do 2019 and 2018, Abi. But that 2018 that you are doing is the end of 2018. Do you understand? They're not saying that the beginning of the prior year comparative period, get the balances of those ones too, and apply that policy to it to ensure that, to do it as if those policy had always been in place even as at that particular period. So accounting, what's the treatment of account changes in accounting policy? It is retrospective. Retrospective. So let's go to changes in accounting estimates. Changes in accounting estimates. An accounting, sorry, this particular section is not treatment, it's just the intro. Hold on, please. An accounting okay. Accounting estimate is an approximation of the amount of a business transaction for which there are no precise means of measurement. It is made for an item in the financial statement when the item cannot be measured with precision and there is some uncertainty about it. That is an estimate. And examples of estimates are what we do with depreciation. We really don't know how much of the asset we are using. Do you understand?
Yes.
The final amount that you say we are reducing our asset by this amount is an estimate. You really cannot say this is the value. What we do also about provisioning for doubtful debt, where we say we are keeping a particular amount, Abi, to say 10% of the asset of the debt we cannot collect back again. We didn't measure it to a degree of certainty. We only assumed, either based on historical records, do you understand? Or maybe one policy asked us to do that. What about inventory? Inventory obsolescence? What about the useful life of non-current assets? You assumed that it's going to be 6 years. What if it was 2 years? What if it was even 15 years? Do you understand? So all these things, the figure that we use to compare or that we use in our income statement to reduce our income at the end are just estimates. So estimate and accounting estimate is an approximation. It's not the exact. It's an approximation of the amount a business transaction with there are no precise means. It's an approximation. An estimate is therefore based on to some extent on management's judgment. His judgment is management that will say, well, this is what we want to use. Even in depreciation, the policy says that you must depreciate an asset, right?
Yes.
At the same time, it also tells you that if you want to, any way you want to depreciate your asset is fine by you. Either you want to do reducing balance method, you want to do straight line method. There are even some other methods in the US GAAP that they are using to depreciate. Do you understand? Different methods. And these different methods will give you different estimate amount to reduce your income by. So what is the difference between an accounting policy and an accounting estimate? Accounting policy is a standard. When they say something is a policy, it's a laid down rule. An estimate is usually how you apply that standard or an approximation of an amount. Let's look at a clear example. Look at the accounting policy. According to IAS 16, depreciation of plant, property, and equipment must be done over its useful life. And we know that to depreciate That is the policy. Policy says depreciate. But accounting estimate is when you are changes in accounting estimates rather, is when you change the policy from you were using straight line method before, and because your total asset was 200 divided by 5, you want to use it for 5 years, 200 divided by 5 will give you 40. Then after, like, this year we might not make income, so let's change the policy from straight line depreciation to reducing balance method. Or you now decide to say, let us increase the useful life from 5 years. If we increase the useful life from 5 years and we put the useful life to 10 years, are you getting what I'm saying? 200 divided by 10 will give you 20. So the depreciation expense for that year will be 20 instead of 40. So there are now some set rules to say that, to guide changes in accounting estimates. So you can't just be changing accounting estimates anyhow you want. So it now says, see, what are the treatment of change in accounting estimates? A change in accounting estimate is accounted for prospectively. In this one, we are not looking back. We are doing what? We are looking forward. We are looking forward. This is the example I just gave now, but it's different, but let's just look at it together again. A non-current asset was purchased for 200,000 naira 2 years ago, when its expected economic life was 10 years, and its expected residual value was nil. The asset is being depreciated by the straight line method. A review of the current assets at the end of year 2, they have done 2 years, they have depreciated 2 years. If you do 200,000 divided by 10, your depreciation using straight line method will be what? 20,000 naira per year. Is that correct?
Yes.
Do you know how I got that?
Yes.
Okay. So it will be 200,000 divided by 10. So you reduce your asset by 20,000 naira every year. So the original depreciation charge will be, so you have done 2 years. So that means your asset value at the end of year 2 is supposed to be like 160 at the end of year 2. But it now revealed at the end of year 2 that due to technological changes, the useful life of the asset is only 6 years in total. You will discover that it was only 6 years in total, and the asset therefore has a remaining useful life of 4 years. The original depreciation charge was 20,000 naira per year, which is what we said earlier. And at the beginning of year 2, its carry amount is 180, which is this. The change in the estimate occurs in year 2. The change in estimate should be applied prospectively. So that means from year 2 onward, year 2 to year 6, we have not changed that we are doing straight line method, but because we have reduced the number of years from 10 to 6, we would have, this is what we call changes in accounting estimate. Our previous estimate was how much? 20,000 naira. If you now do 180 divided by 4 years that is remaining, you get something like 36,000. Yeah. So 36,000. 180 divided by 5 years that is remaining, rather, you will have 36,000. So your accounting estimate has changed from 20,000 to 36,000. And that's what we call accounting estimate. And how do you disclose accounting estimate? The following must be disclosed: the nature and the amount of change in an accounting estimate that has an effect in the current period, or it's expected to have in the future period, except for the effect on the future period when it is impracticable to estimate. So you will go to your financial statement, into your note, you disclose it there. Then the fact that effect in the future period is not disclosed because estimating it is impracticable. Now, in a situation where you can now disclose the impact on your future, on the future, because it is impracticable to do so, then you will also state that there. If you look at this thing, how to really remember it, either for exam or anything, disclosure as much as possible. They want you to disclose what can happen and what is happening. If you look at it that way, even for all your standards, you'll be able to, if you put it that way, disclosure, they don't want anything hidden. So anything you think of in the exam that should be disclosed, right there, that should be disclosed. The fact that you cannot even give the future, you can't discuss, is impracticable to determine the impact on future accounting periods. You disclose that there. That I am unable to, do you understand? To determine the impact on future accounting period, you write it down there. So that is changes in accounting estimates. Let's look at errors. Errors. Don't forget, the IAS we are looking right now is IAS 8, and the title is Accounting Policy, Changes in Accounting Estimates, and Errors. We have looked at accounting policy, and we have said that it is applied retrospectively. We looked at changes in account, and retrospectively we said means you apply it to the previous year, to the previous periods, to the beginning of the previous period on the minimum. Then we looked at changes in accounting estimates. We defined what accounting estimates are, and we said the application is what? Prospectively, looking forward, looking forward. Now we are looking at errors. Errors. Errors happens every time. People make errors. The same way you can make error and you send text message to the wrong person. The same way people make errors in the preparation of accounting statements. If you determine the error before it was published, and by published we mean that before everybody has seen it, you have sent it to the users of the financial statement. When you are still preparing it, you determine the error. What do? Maybe you will correct it, right? You will correct the error there. But in some situations, you will have published the financial statement, and you will now see an error later. This is the policy, the standard that deals with that is IAS 8. If you have checked financial statement before, probably the ones I asked you to download, you will see that some financial statements will have, maybe they are doing 2020 financial statement, which is the current year. You will see the 2019, they will write restated on it. That restated, once you see it in the financial statement, it means that they made an error in some parts of the 2019 financial statement that they declared. They are now just using this 2020 to correct that error. An error treatment, according to IAS 8, is retrospectively, meaning you have to go back to the place where the error was first detected and you must correct it. See, accounting for the prior year error, you see here now, all material prior period errors should be corrected retrospectively in the first set of financial statements following the discovery of the error. So you are in 2020, you made an error in 2018. That 2018 financial statement, you must go back there and correct the error. Transfer it to 2019, correct the error. Then in your 2020 financials, you now leave it. So you will restate 2018 financial statement, restate 2019 financial statement. Then, all the difference of the errors that you occurred before will have cleared off, and you have a good financial statement. So let's look at this. Can you guys hear me? Please
Yes.
confirm. That you can hear me? Okay, thank you. Let's look at the illustration. In preparing his financial statements for 31 December, an error affecting 31st December 2018 20X8 financial statement. The error should be corrected in December the error should be corrected in 31 December 20X9 financial statement by restating the comparative figures for December 31 20X8 at their correct amount. If the error occurred in December 31st 20X7, the comparative opening balances for the beginning of 31 December 20X8 should be restated at their correct amount. So you go back, which was what I explained before, and you correct those places where the errors have been noted. Then let's look at the disclosures of prior period errors. In what's the disclosure requirement? Is the following information must be disclosed: the nature of the period error, of the prior period error. What's the nature? Did it affect assets? Was it retained earnings that was calculated wrongly? What kind of error is it? Was it that you transposed numbers? Do you understand? Whatever the error is, you disclose it. The amount of the correction for each financial statement item. Oh, inventory. We corrected 20,000 naira there, you put it there. Receivables, you corrected this part, you put it there. For each item, for each period, you write it out. All this will be done in the what? In the notes to the account. That's where we do our disclosures. Then the amount of correction at the beginning of the earliest prior period. I defined what earliest prior period meant, right? You are in 2018 now. You gave financial statement for 2017. The beginning of 2017 is what we call the beginning of the earliest prior period. That is at the start of the period. And at the start of period means what? The balances of the previous period. The amount of yes. Then if retrospective statement is not what practicable for a prior period, an explanation of how and when the error has been corrected would be provided. You must provide those errors. I hope that you got this. I told you is more focused on how you state this how you state the corrected information or how you apply them in financial statements. So let me quickly give like a class. How do we apply or how do we treat accounting estimates, changes in accounting estimates, policy, and error? Motun, how do we treat changes in accounting estimates?
We treat it in
Is it prospective or retrospective?
It is prospective.
Changes in accounting estimate, prospective. What about errors?
Errors is retrospective.
Okay. What about changes in accounting policy?
It's retrospective.
It's retrospective. I think that's fine. So that will be the end of IAS 7. IAS 8. And now we'll be looking towards IAS 7. IAS 7. So IAS 7 is called Statement of Cash Flows. Statement of Cash Flow. If you remember, during our IAS 1, we had already said that there are 5 components of a complete financial statement. Can you please help me list them out? Farida. What are the 5 components of a complete financial statement? Just give me one.
Sir?
Give me one.
What are the what?
When we looked at IAS 1, we said that for a complete set of financial statements, there are 5 components. One of them is statement of cash flow. So I've stated one. I've given you guys one now. One is statement of cash flow. What are the other 4? Financial statement. Complete set of financial statements includes what? There are 5.
Statement of financial position.
Thank you. Statement of financial position. Motun?
Income statements.
Yes. Income statement. Farida? There are 2 more.
I can't remember.
Okay. Motunayo?
Statements of cash flow.
I've mentioned statement of cash flow already. I said you guys should not mention that one. And that is on the screen now.
Okay. Statements of change in equity.
Statement of changes in equity. Farida, do you know the last one now?
No, I can't remember.
Motun, do you know the last one? I've mentioned it severally today. Okay. Notes to the account.
Okay.
Do you remember now?
Yes, sir.
Notes to the account. That is where you have all the disclosures I've been mentioning since. Do you understand? Notes to the account. So I'm sure you guys have looked at income statements. You have looked at statement of financial position. Today, we'll be looking at statements of cash flow to continue our standard class. So, statement of cash flow. Cash flow sets out the requirement. IAS 7 is what covers statement of cash flow. And it shows a breakdown of how cash moves in and goes out of an organization. Do you understand? It shows a breakdown of how cash goes in and how cash goes out. It also breaks it down into different segments. And if you look at it, you now say, what is the aim of that? The aim of the cash flow statement is to, number 1, provide information to users of financial statements about an entity's ability to generate cash and cash equivalents. So they'll be able to see, this business, it might be making profit. Do you understand? But might not have cash. Are you getting it? You know, there's a difference between profit and cash. If you look through when we discuss the accrual method of accounting, someone might be owing you money, right? But you record it as revenue. Is that correct?
Yes, sir.
And you declare it as profit, but that does not mean you've collected the cash. So number 2, to assess the ability of the entity to generate cash and cash equivalent. In the business, in accounting, we say cash is the lifeblood, is the blood of a business. Any business that cannot generate cash, that business would eventually die. If you like, it should make all the profit in this world. So how do you now know if this business that you are saying is making profit that is accrued that you cannot collect? Do you understand? How do you know that it can actually pay back the loan you have given him, or if it is a sustainable business to invest in? Is a cash flow statement that will reveal that, because the cash flow statement will show you the movement of cash into the business and movement of cash outside the business. Number 3, you'll be able to assess the cash need of the entity. You'll be able to see, does this business need cash? You understand? You look at their cash flow statement, cash is not entering. Or all their cash, they are using it to pay debt. You'll be able to know. Number 4, you'll be able to compare the performance of the different entities with the cash flow statement. You see this one, is the operating cash flow doing fine? You look at another one, this one might be making more profit. Do you understand? Because of accounting entries and because of accruals and the focus of different, we just look at accounting policies and estimates. And while we're doing it the other time, I told you that somebody can decide to increase his own useful life of assets. You remember now, A and B bought assets of 1 million. One said he was going to depreciate his asset over 20 years. So he's deducting only 5,000 from his profit, while the other one says it's going to depreciate over 10 years. And he's removing 10,000 from his profit. One person's profit will be higher. Is that correct?
Yes.
Yes, one person's profit will be higher. The person that is depreciating over a shorter period, his own profit will be lesser. So there are different things that comes into profit. So profit alone is not a good comparison. Unlike cash flow, that it is not affected by all this policy, it only shows you money that came in and money that went out. Number 3, to evaluate changes in the net assets of an entity and its financial structure, including liquidity and solvency. This one will show you how the movement is going. Is this business selling off all its assets? You will see it. If you sell off assets, money will come in now, right? You will see it. If you're selling off all his assets, you will see it. You will see that instead of investing, if you are investing in a business, you'll be buying more assets, Abby. You will see it. Like, is the money going in or is the money coming out? Then you also be able to show whether there was an increase or decrease in the amount of cash held by the entity between the beginning period and the end of the period. A statement of cash flow categorizes inflows and outflows of cash under 3 broad headings. And the headings are namely cash flow from operating activity, cash used in or obtained from investing activities, and cash paid or received in financing activity. There are 3 broad categories in your cash flow: operating activities, investing activities, and financing activities. We'll look at all these activities in details during the course of this class. Let's move. Let's blaze. So I was saying the other time that what are the differences between a statement of cash flow and the statement of profits or loss? The statement of comprehensive income is prepared on an accrual basis. I said this earlier, and that the profit is only an indicator of performance, while on the other hand, statement of cash flow is prepared on cash basis, which is a useful indicator of a company's liquidity and solvency. We are not saying one is better than the other. We are just saying that income statements will just show you that this company, they are making money. This is the profit. Do you understand? It's a profitable business. That is what we show you. But it won't tell you if the business is going to die or is in a state of dying, right? It won't show you if they don't have money to do business, that all their money is outside. So Statement of cash flow will show you the solvency and the liquidity part of the business. Do you understand that? Then number two, cash flow is a better measure of the ability of the entity to meet its debt obligation as they fall due than profit generated. So everything regarding statement of cash flow is more about liquidity and solvency. And liquidity is what? Ability to meet your short-term obligation. Solvency is to, if the business will be in operation in the long run, while liquidity looks at the short run, the solvency looks at in the long term. But despite all these beautiful things that we have said about the cash flow, there are some limitations. And the limitation is that the statement may not be able to provide the required information for the future because it uses historical data. It is based on what happened in the year. You can use it to forecast, but it's not, it's still an information, do you understand, that has happened before. Number two, some non-cash transactions that are not disclosed on the face of the statement are of interest to users because they will impact on future cash flow. So you don't mention some non-cash transactions on the income, and non-cash transactions are, for example, provisioning, right? Provisioning for bad debt. You know, you didn't spend the money. You're only saying you are removing from your profit. Do you guys understand what is non-cash? Let me first start from there.
Non-cash.
Non-cash. When you say non-cash,
There is no cash transaction.
yes, cash is not involved. For example, when you are doing depreciation, you know, you remove the money from your income, right?
Yes.
You know, you remove depreciation expense from your income.
Yes,
Have you
sir.
guys forgotten?
Yes.
Yes, but the money did not leave the organization. Are you aware?
Yes, sir.
When you do provisioning for doubtful debt, the provisioning expense, you remove it from your income statement, but you don't spend the money, right? So those are the ones we call non-cash. Yeah, you've removed them as expenses, but money is not leaving the organization. So those are non-cash. And those information might be of interest to users in the future because, for example, provisioning that you are removing now, yes, the cash is with you. But when the debt goes bad in the future, do you understand? The user might want to know what is the level of debt that we know what we have. And that's the reason why the old financial statement, from income statement to statement of financial position to statement of cash flow to statement of changes in equity and to the notes to the account, they are all as important as the others. Every of those statements are as important as the others because the information, the financial and the statement the user needs is resident in each of those things. And we have different users and their needs are also different. So they look at it from different angles. So I'm now showing you a broad format of the statement of cash flow. If you want to write it down, but please know that you also get these slides. This is the broad format. You have your cash flow from operating activities. You remember there when I said we have three broad headings for the cash flow statement. You remember when I said cash flow from operating activities, cash used in or obtained from investing activities, cash paid or received in financing activities. That's it here. Cash from operating activities, we sum everything together. It might be positive. See the first X means positive. It might be negative. Cash flow from investing activity, you put it there. It might be positive, it might be negative. Cash flow from financing activity, positive or it might be negative. We sum these three together. Anyone that is negative, we remove it. We sum all these three together. And that is how we get our net cash inflow or outflow for that particular period. If it is negative, we will call it what? Net cash outflow. If it is positive, we will call it what? Net cash inflow. Then we are going to add our cash that we had at the beginning of the year. Whatever we added to our what came in during the year plus what we have at the beginning of the year, then we'll have our cash and cash equivalent at the end of the period. So you might want to ask, what is cash and cash equivalent? That leads us to the next part. Cash and cash equivalent. Cash comprises cash on hand and what you have in your demand deposit. Demand deposit is something like current account. You don't have to tell the bank that you want to come and collect your money. That is demand deposit. That is cash. Whatever you have, your bank balances, they are what? Cash. Cash equivalents are what we call short-term, highly liquid investments. So if you have money in your fixed deposit, you have money in your treasury bills, do you understand? They are what we call cash equivalents. You have money in one fixed deposit that if you tell the bank you want to withdraw with a notice period, those are cash equivalents. You bought government treasury bills, cash equivalents. So cash and cash equivalents are held in order to meet short-term cash commitments rather than for investment purpose or purposes. The real purpose of having them is for you to meet short-term cash commitments. So you put those cash with you, you hold them, and you say, oh, let me keep this cash here. But rather than just keep it lying around, do you understand? Let me be making some money on it. Do you understand? But the real reason that you kept it is not because you want to make money on it, but just because in the day there's no cash, you can easily call the money and you use it for what you do. That is cash, the real purpose for cash and cash equivalents rather, while cash is the real cash you have on hand, your petty box, and what you have in your current account, which we call demand deposit. So we are going to take this cash flow from operating activities that we have here, the investing activities and the financing activities. We are going to take them one by one. Then the operating activity, we'll take that one last, but we'll look at investing and financing activities first. Then we'll take operating activities last. But when you're preparing your financial statement, you prepare in this format: operating first, investing, financing, do the net of all this, or of the three. Either you get an inflow and outflow, add it to the cash that you had at the beginning of the period, then you will have the cash, then you will now get the cash at the end of the period. So let's look at what we look at investing activity. Investing activities, these are cash flows of the entity that relate to what? Acquisition and disposal of property, plant, and equipment, financial assets and investment properties, and any other non-current assets. So when you say investing, you are looking at what? Acquisition or disposal of property, PPE. Or you have invested in other businesses. All these ones are called investing. Anything that has to do with acquisition and disposal, as you saw it here. So let's look at the common examples of what we would term as inflow for investing activity. If I sell my house, we're using a business. If I sell the one of my business equipment, any money I receive from it, the business equipment is not what I do. I don't wake up every day to say I want to sell my asset I'm using to generate money for my business, right? So if I sell any of the assets, any of the property, or any of the non-current assets rather, I sell any of the property, any of the equipment, any proceed I get from it is what we call cash inflows from investing activity. Another inflow is proceed from the sale of investment. I invested in another company, right? That is not my business. That is not my core business. That's not what I do on a day-to-day basis. So I invested in it. Proceed from it is from investing activity. That's cash inflow. Collection of cash advances. I gave somebody money. I gave third party money. I collected it back. Is cash flow from investing activity. The company that I invested in, they pay dividend. Dividend received from a company that I invested in is cash inflow from investing activity. I gave money to a third party. They paid interest on it. Like I borrowed somebody money and the person paid interest on it. Cash interest received is from investing activity. Now let's look at the outflows. The outflows will look like purchasing of property, plant and equipment. You went to buy shares in another company or any other investment. You made cash advances to third party, either by you borrowing them, that's cash outflow of investing activity. At this point, is there any question from this? Do you guys understand what investing activities are from a cash flow statement? Any question?
No, sir.
Okay, thank you. So let's look at financing activity. As I said, whenever there are questions, please pause me, ask me to explain again. I'll go over it as much as possible until you understand it. So now let's look at cash flows from financing activities. These are cash flows that relate to changes in the size and composition of the equity and borrowing of an entity. Once I finish this, I will explain how I use my own style to remember the definitions of this three broad headings of the cash flow statement. Let's look at the common examples. Common examples are cash inflow. For cash inflows are cash received on the issue of shares. Now, you are the one that issued shares. People now subscribed to your shares. They gave you money. They are financing activity. Financing activity. Let's go again. Cash received from issuing debt instruments. You issued a banker's acceptance. You issued commercial paper. People subscribe to it, they gave you money. Or you issued a bond. is called financing activity. Proceeds from bank borrowings. The bank borrowed you money. Money came in. They borrowed you money so that you can do your business. It's called what? Financing activity. Now let's look at what would go as cash outflow. What would go as cash outflow? When you pay dividend to the shareholders that you issue shares to. Can you see the first line when we're doing cash inflow? When we said cash received on issue of shares, you pay shareholders dividend now. When we look at structure of business, you remember, you pay shareholders dividend. When you pay shareholders dividend, it's an outflow, yes, but it's a financing activity. When you repay the principal portion of the debt that you borrowed when you issued your debt instruments, is financing activity. When you repay the money that you borrowed from the bank, is also financing activity. Financing activity. Now, let's look at operating activity. Operating activity. Operating activities are revenue producing activities of the entity. Revenue producing activities of the entity. And these are any other activity that is neither investing or financing activity. Common examples are, let's see, what are the common examples of operating activities? Operating activities, let me explain that one once again. Operating activity is number one, anything that is not investing and is not a financing activity. Let's even first start from that. It's not an investing and it's not a financing activity, number one. Number two, they are usually related to revenue producing, like revenue generation, usually related to your day-to-day operations of the business. Those are operating activities. Let's look at the cash flow, or the common examples of the cash inflow rather. Cash receipts from customers from sale of goods or services. Cash receipts from customer from sale of goods or services is a cash inflow. Consequently, Abi, when you pay suppliers, you purchase goods, now one will be what? Cash outflow. Number two, royalties, fees, commissions, and other revenue received in cash. Those ones are what? Cash inflow. Income tax refund. That one hardly happens in Nigeria, but in same countries where you paid more than the expected tax and they are giving you refund, and they are giving you, that's a cash inflow from operating activity. Cash receipts from insurance claim. You had insurance and maybe something happened and they pay you back. It's not an investment though, and it's not what? It's not financing. It falls under operating activity. The cash outflow consequently also will now be cash payments to suppliers of goods and services, cash payment made to and on behalf of employees, income tax paid, unless the payment can be specifically identified with financing or investing activity, otherwise it remains as operating activity, cash paid for insurance premium. So can someone explain the three cash flow broad headings the way you understand it? Cash flow from investing, or we pick it one. Farida Amotun, cash flow You can pick anyone you want to. So pick the one quick before another person picks it. Cash flow from investing activity, cash flow from operating activity, and cash flow from financing activity. In your own words, how you understand it? What do they stand for? What do they represent? But go ahead.
The cash flow investing activity.
From what?
The cash flow investing activity.
Okay.
It represents the one for properties and non-current assets like properties, equipment, and disposable property.
Okay. Okay. Farida, which one are you picking?
Cash flow from operating activities.
From operating activity. Okay, let's hear you.
They are revenue producing activities,
Okay.
and they are not for investing and financing activities.
Okay.
And
Thank you.
other yes, that's
Okay, can you give me an
sorry.
example of inflow, one example of inflow and one example of outflow?
Inflow, cash receipts from insurance,
Okay.
and outflows, cash payments from insurance.
Premium paid, when you paid
Oh,
insurance premium. Yes. Okay, Motunrayo, give me an example of which one did you speak about? Investing activity, inflow and outflow.
Inflow, we have dividend received, proceed from the sales of
Sorry, which one are you speaking about? You are confusing me now.
investing activity.
Okay, that's the one you said is related to property, plant, equipment, right?
Yes, sir.
Okay, investing. So
So
example.
the inflow, we have dividend received. Then we have proceeds from the sales of properties and equipment. Why the
Outflow.
purchases of properties or investments?
Yes, that's cool. That's cool. So the only one we didn't speak about is financing, right?
Yes, sir.
No one spoke about financing. So can you give me definition of financing? What you understand for financing? While Farida will give me the examples. Hello, Motu. Are you there?
Yes, sir.
Or Farida, do you want to give me the definition or what you know about it? Then Motu gives me the example. Which one do you guys want to do? How do you guys want to do it?
definition.
Farida, you are muted. We can't hear you again.
I said the definition of what I need to do something. Sorry.
Oh, definition of. So you spoke on operating activity. Motunrayo spoke on investing activity. So I said, can you define financing activity? Then Motunrayo would give the example of financing activity. In your own English, don't use my English, the way you understand it. Any one of you, financing activity.
It deals with the equity and the borrowings.
Okay. Okay, Farida, give me your own word.
It relates to changes in size and composition of equity.
Yes.
Yes.
Borrowings. So it's not only equity. Do you understand?
Okay.
So you guys should give me examples of inflows and outflow. This way you're able to understand it. So I'm not putting you on the spot, but it allows you to join the class. Do you understand? And for you to understand it. Put it in your language.
Inflows, cash received on issues of shares.
Okay. Yes, you are
Then
correct.
Then outflows, dividend payments
Dividend
to
payments
shareholder.
to shareholders. Okay, Motorayo. One inflow, one outflow.
One inflow, one outflow of financing activity.
Yes.
Proceed from bank borrowings.
Okay.
That's for the inflow. Then for the outflow is the repayment for the bank borrowings.
Okay. Okay. So I'm happy that you guys know that. So we'll be able to. So if you see a question and they ask you to separate these activities into different buckets, you'll be able to do that, right? I expect you guys to be able to do that. So those are the three main methods. So you know that for a cash flow statement, inflow will be positive, Abby, and outflow will be negative.
Yes, sir.
Right. So the reason I picked cash flows from operating is that as the last one to talk about, so that we can speak on the two methods of preparing cash flow from operating activity. It has two methods. The others, investing and financing, just put the inflows right against the outflow. Whatever you get as the balance is the balance. You remember when I showed you guys this? Hold on. When I showed you guys this. So before you get this cash from financing or investing, either as positive or negative, you will add all the inflows together, add all the outflows together, remove the inflows from the outflow, then you get your balance. That is it. Let me see if I can show you guys something on Excel. So let's say cash. So your typical your format for cash flow statement is like this: cash flow from operating activities. So he has this is my English or from. You can see my Excel, right?
Yes, sir.
Is that a yes?
Yes,
Yes,
sir.
sir.
Okay. So it'll be like this: cash flow from operating activities. There will be several lists of operating activities. Then there will be cash flow from investing activities. Then you have, let's say, sale of PPE. This one will be, let's say it's 10,000, because that's the part I wanted to explain. This other part here, operating activity, will go into that one in details. Sale of PPE, right? I bought purchase of PPE. So during the year, I sold some of my old assets that were already going, let's say at scrap value at 10,000. But I bought asset of 1 million. That would be minus 1 million. Are you guys following? Let me put yeah. Can you see now? So you can see it's easy like that. Let's say that I also received dividend from some of the company that I have. Dividend that I received though, it's inflow.
Yes.
In the investment I have, let's say it's 50,000. That's the dividend that came in this year. So my net cash flow from investing activities will be addition of all this. Huh? Let me expand this place. Oh, sorry. So it will be addition of all this equals to sum. Are you getting me? Can you say that this is a negative?
Yes.
The same way. That is how cash flow from investing is. Let's now do for cash flow from financing activities. Financing. Cash flow from financing activities. What are the things that are financing activities? What are the inflow? Give me some inflow. We got loan from the bank.
Yes.
Let's say term loan for the bank. They gave us for maybe 10 years. Loan of how much, Motun, did we get?
10,000.
10,000. 10,000 or 10 million?
I said 10,000. 10,000.
10,000, okay. Loan of 10,000. We got loan of 10,000 from the bank. What are the other inflows for financing? We sold shares. Proceed from sale of shares. How much shares did we sell? What's the value? Let's say 2 million naira worth of shares. All these are inflows, Abi.
Yes, sir.
Which outflow should we use? Let's say dividend payment. Dividend payment. We paid dividend of outflow. So you can see I'm using minus now. Minus, let's say we paid dividend of 100,000. And this is 1 million. Yeah. Let's just change it to 200,000. So this one too will sum it up. Right? You can see that this is positive, this is negative, right? Then this one is what we will explain now. But let's just say that we are assuming that all the cash flow, sorry, let me put this one here too. Net cash flow from financing activities. So let's just put a figure here. How we get the figure, we'll explain in our next example. So let's say net cash flow from operation is 1 million. Are you with me?
Yes, but sir, why is this place negative, sir? I can't remember.
Which one?
This 940.
This one?
Yes.
It's negative because you spent more money investing than more money in sale of your investment. You remember what we called investing as?
Yes.
Investing activity. You remember what we call it as?
Yes.
So if you look at it, I said sale of PPE is you sold your scrap PPE, right?
Yes, sir.
Of 10,000. But if you want to buy a new one, it will be costlier now.
Yes, sir.
So you bought a new property, plant and equipment for 1 million. If you do 10,000 plus 50,000, that will be 60,000. If you do minus 1 million, you get minus 940. Is that correct?
Yes.
Okay. So net cash flow from investing activities is negative. Don't care about the negative part. If you did your placing right, do you understand my point?
Yes.
Normally, it should be negative. If you see a business that has net cash flow from investing activities as positive, what would that tell you? What would that tell you? A business that has net cash flow from investing activities as positive, it means that business is selling off his assets, his PPE, right?
Yes, sir.
That's what it means. And if you are selling your PPE, it's either you are going out of business. Do you understand? Either you are
Yes.
going out of business. So normally, for a business that is working, you should be investing more. You should be buying more property, plant, and equipment than the rate at which you are selling them. Or even if you are investing in several businesses, you'll be investing more than the way you are selling. So this is not like out of place. Then from financing activity, you are getting more money from the banks than you are paying out. That's the meaning. Do you understand? Like this term loan now, we did not even do any repayment for it this year. You can see we sold shares, and that's the reason why we have net cash flow from financing. So if you go back to this slide, this is what was done here. Cash from operating was what we did. Next one was what we did, and this one was what we did here now. Now the net cash inflow on outflow during the period is this is how you do that one. You sum this and this and this together. That is how you get your net cash flow for the period. See, net cash flow for the period. It's as simple as this. So it's as simple as this. But let me see. This is not summing properly. It's supposed to start from here. You can use your calculator too to confirm. If you do 1 million minus this, that will give you like 60, then plus 1,910,000. That will give you 1,970,000. That will be your net cash flow for the period. Then after you have done this, you now go ahead and say cash and cash equivalent at the beginning of the period. You state the amount here, right? You add it together. Can you see? And you add it together and you get your cash and cash equivalent at the end of the period. So let's say when we started the year, it was 500,000 naira that we had. 500,000. That was our money at the beginning of the period. Then the total money we'll have at the end of the period equivalent at the end of the period. See, if we add 500 at the beginning of the period, you know this one, this section here, where we did net cash flow from operating, from investing, you know this one happened only this year.
Yes.
Then we made 1.9. That means the whole money we have at the end of the period will be this 1.9 plus what we had at the beginning of the period. And this is what we'll have. So this is the cash we'll have at the end of period. You know, when we were doing it, we said some of the objective is we'll use it to compare. Is this business doing fine? How do you compare the cash this business had at the beginning of the period to the cash it has at the end of the period, right? So this is just the general format of cash flow statement. However, you know, this part, we left it undone. This part, cash flow from operating activities. And that is the part where we said it has two methods. It has two methods. And we'll be looking at it now. We'll be looking at it now. If we are able to finish it, we'll finish it now. But our time is fast spent. So what we'll do is we will look at the theory part today, right? So let's just complete the theory part. Then next week, we'll now look at the calculation part of it. If you are able to finish it, then we can go to the assignment. But I doubt it because it has some calculations for the direct method, for the indirect method that we have to look at. Do you understand? So let's just look at it. But the good thing is that we have finished the carcass, which is what we've done here, and this is how it looks like. You just substitute all these our things that we're doing, which one represents inflow. So when you hear sale of PPE, you know that sale of PPE goes under what? Investing. Investing, is it an inflow or is it an outflow? Is money coming in or money going out? If I sell plants, that means I'm going to collect money, right? I thought I was going to tell you another way that I used to use to remember it. I used to remember this part as anything current asset / current liability. Are you following me?
Yes, sir.
If you know my own part, my own way will not work for you. Just know that definition. If you can solve these two, you will know what else is here. If you see the definition that I gave you for operating activity, they said what? Something you use for your day-to-day affairs, right? And any other thing that cannot be classified as what? Investing and financing. Do you remember? So if that one is there, so this one, equity and non-current liabilities. This one, non-current assets. If we are doing our financial statement, is there any part I've not included? Our financial statement is current asset, Abi, plus non-current asset. That will give us total assets. Then we'll go to liability, current liability plus non-current liability, right? Will give us total liability, then we'll have equity. Is there anyone I've not picked? I've picked equity here. Non-current liability is here. Current liability is here. Non-current asset is here. Current asset is here. This is another method. Another way that I used to know it again. Now I'm giving you different ways on how you can store it in your brain so that it's easy for you to remember at any point in time. Because why would we have found out a way to get it in the exam and we are not telling you? Do you understand? Not just stick by the textbook alone. Another way that I used to remember it, once I remember either investing or financing, I told you, once you remember one of these two, you'll be able to solve what operating is. When I remember what financing is or what this one is, I'll get the rest. So financing, bank gave me money. Apart from bank giving me money, financing, once I hear financing, bank gave me money, shareholders gave me money. Those two, financing. If I'm paying bank back their money, financing. Once I know the one way, I'll get the other way. Bank gave me money, shareholders gave me money. It speaks to what? Equity and loans, right? Composition, increase in composition of equity, right? That one we said. Financing, that's financing. If I'm using investing, I start from, I'm buying property, plant, and equipment. I'm putting my money in another company for the purpose of what? Of getting returns, right? That is investing. It is not what I do in the normal course of business. So I won't be putting sales or purchases under investing, that I'm investing in my inventory. No, that's not it. And that's the reason why I gave you another formula here, non-current assets. Do you understand? Then when I'm selling those assets that I invested in before, it counts as what? Inflow. If you look at when I explained this, I explained it from the positive side. But when I explained this, I explained it from the negative side. And that's the reason why Moto asked me the question the other time. I said, investing activity, normally it should be negative. Normally. But that does not mean it cannot be positive. And I said some instances where it could be positive would be when the business is selling off its assets. Then I know anything that is left, operating activity. And what will I find in operating activity? I sold my inventory. I purchased goods. I bought something from suppliers. My working capital which is inventory, receivable, and payables, and any other thing that cannot be classified as these other two operating activity. Can you see that it's done? But let's go back to the cash flow from operating activity. So we have the direct method and we have the indirect method. I think this is a good place to stop. This is a good place to stop. So that when we come the next class, we will explain the direct method, we'll solve examples, we'll do the indirect method, we'll solve examples. You can see there's different class work here. We'll solve examples, then we'll take our assignment. Last week, some of you did not submit your assignments. Please, it's for your own sake, submit the assignment. It's for your own sake. Either you got it or you did not get it. You watch the video, you did not come to class, but you watch the video. Send your assignment. Let me look at it to be sure that you got the right answer. If you are still watching the video today after 1 month, reach out. Let's review what you have done. It is when we review what you have done.
Sir, are those videos to be sent to us personally? Or they are on the
No, you ask the admin. There's a link to the video. Do you understand? Reach out to the admin that you want access to the videos of the class. Do you understand? Reach out to the admin. There's admin in every group. The person that added you to the group is the admin. Reach out to the admin or the person that sent you this weekly link for the class. Do you understand? Reach out to him that you want access to the videos. He would give you the link to the access. Do you understand? And that link is updated every time. So once you have the link, anytime you go there, you will see the classes that we just finished. You will see the previous classes so that we can all prepare together. It's already, our time is almost up for today. Do you understand? But I hope you guys understand the little part that we're able to do for IAS 8 and for IAS 7. Do you guys understand it?
Yes.
Okay. So thank you so much for coming once again. I appreciate your tenacity, and I pray that God will give you beneficial knowledge, wisdom, to understand and pass this exam once and for all. So thank you for coming again. I'll stop the recording now. If you have any question, you can wait and or any other personal question. Is there any question related to the course? Let me take that now while we are still recording.
Yes, sir.
None, sir. Okay. Thank you so much. I'm stopping now.
Thank you, sir.